But Sameer Dalal as well joins in on the show right now to talk about which way he feels the market is headed. Sameer, hi, good morning. And it seems like we're doing quite okay. Finally chugging along nicely. New leaders emerging every day. Friday it was Bajaj Finance doing its magic, and we've made it to that 24,450 mark. Seems like a new high could very well be on the cards.
So a new high of 26,000 seems a little difficult, to be very frank, Aisha. Anyways, thank you for inviting me to the show. So the market seems to be taking a lot of the positives right now and moving along, which is a great thing because, we've been in a lull in a range for, I guess, a period of maybe 2 years plus, and we are looking for some direction. Unfortunately, every time we do get some positive direction, the news geopolitically changes and it kind of puts pressure on the Indian economy, and rightfully so, because when crude moves up, it does hurt our current account, and then it does affect companies that are using crude derivatives as some of their materials, right? So it kind of is inflationary in nature. Now, the question of can we go ahead and keep moving along? Well, if the crude prices don't show too much volatility, if we get some direction, yes, we could start moving up closer to the 200 out levels. But you also got to look at what constituents of the Nifty are going to lead the market up, right? So yesterday, you rightfully said Bajaj Finance moved up, and that was a big positive. IT seems to be showing some resilience, given the fact that the AI trade is getting a bit of a cool off. So Indian IT services businesses are starting to see an uptick. But the question is, can we continue that momentum? That is the thing. And the stocks that really need to get their mojo back, and if you want the market to go up, one is Reliance Industries. There is scope of that in the near term, given the fact that they have the IPO of Jio Telecom coming about. So hopefully that does well. And the second is HDFC Bank, which has actually been a real underperformer if you look at it in the last 3 to 4 years, right? So what are the triggers that are going to drive HDFC or some of the banking pack up? So banking, after the results, what we saw in the NIM compressions, the markets wanting to see that reversal, and that reversal might take one more quarter. Although I remain very positive on the banking space, the near-term triggers seem to be lacking. So are we ready to make an all-time high with the banking support? I don't think we are. Is Reliance probably going to move? Yes. And I think IT probably you will see some of this benefit fizzling out. So am I saying that we're going to see an all-time high and move up? I don't think we're going to do that anytime soon. I think geopolitics is still a bit of a problem. I think Indian IT is still going to struggle. So I think take it month to month. Auto is the one sector that is absolute standout. Unfortunately, the weightage in the index is quite limited. So that's not really going to help the situation for the index.
Samir, hi, morning. Auto sector is one where we saw a lot of action coming in. You had Maruti numbers, which were little disappointing on the EBITDA and PAT now point of view. At the same time, you had Mahindra, which did well. How do you look at this passenger vehicle segment? And Tata Motors numbers for July has also been very good.
Yeah, so like I said, auto is actually a complete standout, right? If you look at the numbers of sales that are coming through, it's quite phenomenal. I think last time when I spoke on your channel, also we discussed what we saw even in the face of rising prices, with companies passing on higher, prices for the vehicles. Sales have been absolutely fantastic, and that trend continues. So why were Maruti's margins and profit a little subdued? Is they weren't able to pass on the full cost increase that happened, but they are going to do it because I think 1st of August they had a 3 to 5% price increase across the board. So now what you're going to see is if the volume sustain, which they're showing that they're sustaining at the moment, the profitability will come back and that will do well. Now, Tata Motors India operations, like you said, doing extremely well. But the bulk of the profitability for them comes from GLR. And that is where they had struggled in the past. But now look at the beauty of it, because the base that has been created for GLR in FY26 has been so poor because of the cybersecurity fraud, because of the slowdown in sales in the Middle East, thanks to the wars that have happened. I think what you're going to see is they can only start getting better the numbers. And once that starts happening, then people obviously start increasing their ratings upwards. So I remain very constructive there. Maruti, unfortunately, Mahindra and Mahindra also valuations are not cheap in any which way. So, the upside may be capped to a large extent because, yes, I mean, stocks can move up by 5%, 7% in the short term, but can they continue its trajectory up continually over a period of time in the near term? No. So it's going to be a long-term investment. I still think they're great from a long-term perspective, but Tata Motors is the only standout buy that we have at this price point, even though we are as positive on the private vehicle space. Mahindra, if it comes closer to maybe 2,800, we think that could be a decent buy at that point where you could make decent returns. And Maruti closer to the about 12,000 odd levels. But we remain very constructive on the auto and the auto anks as well. Because when auto does well, companies that are supplying products to them continue to do well. So that is another space that one can definitely focus on.
Oh, yeah, absolutely. Auto anks, in fact, I think have been better performers than even mainline auto stocks in the month gone by. But since we're talking about autos, let's start off and bring on board Avi and hear about what the brokerages have to say about Maruti. And then, of course, we'll bring on board Darshita as well as Ashesha and Mitali as well to talk about some of the other newsmakers this morning. But Avi, you go first on Maruti.
So Maruti has come out with its Q1 FY27 numbers, as we all know, and we've seen a margin contraction of a big significant movement because of the commodity cost inflation leading to the triggered by the West Asia crisis. So let's have a look at what the brokerages have to say on Maruti's numbers. Taking first, Citi has reduced its target price from 18,500 to down to 16,500 because of the EBIT margins that the company missed in Q1, which came in way below what they were estimating due to higher commodity costs and a shift to monthly pass-through of increase in prices with vendors. The revenue was roughly in line, but the gross margins came in well below what they were estimating. The capacity raised with the fourth production line in Gujarat is now operational and can work very well in favor of Maruti. Up next is Morgan Stanley, which has also reduced the target price from 17,895 down to 16,381. They say that the management's 10% FY27 domestic volume guidance seems conservative and could well come in the mid-teen range. The low channel inventory, large order book and the new capacity and the 2,000 bookings per day for the new updated Brezza will be the growth triggers for Maruti going forward. Our last brokerage would be Motilal Oswal on Maruti, which has maintained its target price of 17,000 rupees. The demand outlook remains robust with two price hikes that the company has taken and the commodity inflation likely to cool off. The Maruti can be the next growth trigger with a target price of 17,000 from Motilal, target price of 16,381 from Morgan Stanley, and Citi giving it a target price of 16,500.
Thanks, Avi, for that. So Maruti maintaining the FY27 guidance of 10% volume growth. Darshita joins us with Persistent. The profit was hit by a one-time forex charge. Darshita, what do you have on Persistent?
Right, Persistent System has reported a mixed set of numbers for this quarter one FY27, where the revenue remained healthy and grew about 6% on a sequential basis, while the constant currency growth improved to 4.1% versus 3.4% the previous quarter. However, the biggest disappointment came on the profit front. The PAT declined nearly 9% on a sequential basis and also has missed the street estimates, and this was now largely due to the hedge loss of 105 crore. Now, the biggest positive was the deal wins here. Persistent reported a record TCV of $1.15 billion versus $520 million same quarter last year, and the improved book-to-bill ratio now stands at 2.5 times, which reflects healthy demand and a robust order pipeline. Now, on the watch list, the DSO increased by 8 days, while the subcontracting cost climbed to 667 crore, which was up 39% on a year-on-year basis. Now, the important thing to note here is this subcontracting cost has outpaced the company's revenue growth of 30% on a YOY basis. Now, that indicates a greater reliance on the external contractors, which could keep the cost pressures elevated. So overall, strong deal momentum and healthy revenue growth were the key positives, but the sharp profit miss made it mixed quarter for Persistent Systems.
Thanks, Darshita, for that. Persistent numbers. Mitali now joins us with Muthoot Finance numbers and what brokerages have to say on that.
Right, so weaker set of numbers coming in from Muthoot Finance for quarter one FY27, and it was a major miss on their margins if you see. While the growth, it was quite strong for this quarter, but on a sequential basis, if you see, that is where the problem lies. So their AUM, it has risen by 43% on a yearly basis and 6% up on a sequentially basis. But it was led by a 48% jump seen in their gold AUM, reflecting robust customer acquisition as well as sustained demand. Asset quality also improved quite a bit for this quarter. However, the earnings print that disappointed on the larger front. PAT came in at around 2,550 odd crore rupees, which is up 25% yearly, but 17% decline on a sequential basis. Also, their net interest income was also down 16% on a quarterly basis. The key reason was margin normalization. Q4, it was benefited from elevated recoveries, renewal in the gold loan prices, and which led to the top-ups, also making it an unusually strong base as pricing turned more profitable and more competitive. Profitable yields for the portfolio yields for the company, they have now normalized to around 18% for this quarter, leading to a sharp compression. That is what we have seen in their net interest margins. Talking about their brokerages, so they have maintained largely neutral to hold call on this stock, citing pressure on the margins, even as they acknowledge Muthoot's superior franchise, pristine asset quality, as well as long-term growth opportunity. But as of now, wait and watch mode going on ahead. And also, we'll wait out if the management, they are revising any guidance post quarter 2. So as of now, a weak set of numbers for quarter 1 for Muthoot coming in.
Thanks, Mithali, for that update. Samir, what do you have to say about some of the earnings? Divi's, you have Persistent, and then ITC, which came in after market hours.
Yeah, so let's talk about ITC to start with, which is index heavyweight. Look, it was more or less in expected lines, right? So honestly, I didn't expect a 5% volume decrease, which came in a little higher than what we thought would happen in the cigarette business. But I mean, that is part and parcel, because when you increase prices to the extent that you have, it does have some effect on consumption. The problem for ITC, I think, in the near term is that they have one more price hike that they need to take to pass on all the increase in government excise duty that happened over the recent past, right? So if one more price hike happens for the tobacco products, could that hurt elasticity? Could demand further slip? Possibility is yes. And if that happens, obviously what it does is it slows down top line growth. But when the next price increase happens, what you're going to see is margins are going to start moving up, which had gone down in this current quarter. So sometimes, you give up a little bit on the top line growth to ensure that your margins come back to stabilize normal levels, which will happen. And then eventually volumes will get pick up once again, because people will adjust to the new higher pricing, which is beginning to start happening. So the reason why the stock has corrected as much as it is growth is something that has become questioned. That can cigarette volumes grow? Can the cash cow business of the company continue to grow and deliver profitability? If that doesn't happen, then your play is on the FMCG play, which is a highly competitive space. Yes, they've got market share now, and they're getting operating leverages playing out, but people want to see more of that. But I think this is a dark horse in the market at this point of time. People have kind of forgotten about this counter and what its capabilities are, the value unlocking potential that can come from the FMCG. Once the profitability starts increasing and they get more scale in that. So for me, this is actually one of the stocks that one should go out and buy. Results, one more quarter maybe of difficulty, and then things will start looking better. But then because the difficulty is there, you're getting these prices and these valuations, right? Imagine an FMCG company trading at about 20 times earnings. Very difficult to find in today's day, when most of them are trading well above 35, 40.
Kunal, how is ITC looking on the chart?
One of the very weakest of the stocks in the large caps universe, in the FMCG pack, in the Nifty 50. I think it's not performed very well, of course, and we all know the reasons why. I think start of this year itself, ITC fell from 400 levels to 280, 270, where it's trading right now. The only positive part so far about the stock is that it's available at a good risk reward, because it's fallen so sharply in the last 6 odd months, as well as over the last 1.5 odd year, that maybe time-wise, price-wise, the stock could probably come back at a very attractive price territory. But the whole point with the stock like ITC, it requires a trigger to move up higher. Even if you go back maybe 3-4 years, when the stock was at 220 from where the rally started off for ITC and it moved up to 500, there was a major trigger for ITC, and that led to a kind of a huge upside for the stock price. So even if it's the trigger plays out and the stock jumps up by, first initial 5-10%, it's always better to buy the stock at the cusp of an inflection point when the inflection has started off rather than anticipating the inflection point, because the only bigger concern with a stock like ITC when we look at it on a trading perspective is the time the stock takes to consolidate and maybe to form a bottom.
Samir, the other stock being Divi's, good set of numbers, and there's a good tailwind of margin expansion expected in the next couple of quarters.
So unfortunately, I haven't seen Divi's results. I did see Persistent, which was actually, I missed out on answering the second part of your question. Look, Persistent, the order inflow was excellent. I cannot put that apart. The one-off exceptional loss, let's ignore that, because those things are not going to keep recurring. They do have a few hedges in place, which is going to maybe come one more quarter, but not to the extent that it came in. But having said that, look, this is a company that is mid-size in nature, growing faster than most of the other IT companies. So it should get a little bit of a premium valuation, but they also have a big acquisition that they've made, which integration is going to be a question mark. The fact that the stock is still able to trade at the current valuation of 40 plus times earnings comes out to me as a bit of a risk kind of a situation. Not that the earnings were disappointed, but just valuations and the risk of integration remains ahead of it. Growth also, they will, as their size also becomes bigger, they're not going to be able to keep growing at the higher rates that they've been growing, that they will start tapering down. And that leaves a little bit of risk. So I would be a little cautious on Persistent, but Divi's, I haven't seen the results, so I don't want to comment.
Kunal, Persistent, quickly.
See, Persistent on the charts, I would feel that it's a very attractive territory. In case the stock corrects post results, I think Persistent could be a good buy because the IT sector seems to have come back into a inflection point turnaround. I would suggest that dips should be taken as buying opportunity.
Great. So let's take a small break. We'll come back after the break with more, and there are more stocks and news waiting to be unveiled. Thank you.
Back with the market right here on ET Now. Let's just revisit what the Gift Nifty is settling in at. And the last time we checked, 166 points higher. So it's higher than where it was about half an hour back as well. Currently around the 24,600 print. Good going for the particular index. Of course, there's a lot more participation as well. Friday was all about Bajaj Finance. Jio Financials has had an excellent last week. You did have strong earnings reaction come in from the likes of M&M as well. Reliance too, not in a big way, but at least it's been comfortably holding around on an average with a 1% sort of daily gain. Bharti, BEL are some of the other leadership names which are comforting the index. Having said that, the volatile piece in the market of late has been the likes of Swiggy and Eternal. That door fell hard on Friday after Swiggy's disappointment, or at least earnings miss. And these were the two names which came off. Having said that, they've already seen an excellent rally pretty much through the month, or at least in the latter part in the last fortnight or so. But Kunal, want to revisit these charts with you, Swiggy and Eternal, and what do you now foresee?
See, I think both these stocks on the short-term charts, I think are looking a lot more attractive. Eternal, of course, is one of the stronger ones on a relative scale basis. The stock comfortably above 300 levels, has seen a very good volumes. Indicators were deeply oversold for Eternal just 2-3 months back on the daily and the weekly charts when the stock was at 220-ish kind of a zone. And now it's moved on to a zone where it's slightly entering into that overbought territory, but that doesn't mean that the stock will probably top out. It just means that the stock may go into a consolidation a little bit. I think at 300 odd levels, I would sense Eternal could be a very good buy. Swiggy, on the other hand, is a very high beta stock. It has a tendency of going into 5%, 7% kind of a sudden swing. But I sense that closer to 270, 275 could be a very good zone to accumulate Swiggy on a medium-term basis.
Right, okay. A lot of other newsmakers as well this morning, and Darshita and Ashesha are back with us to highlight those. Darshita, what's on your list?
Yeah, right. Here are the stocks that could remain in focus in today's trade. And starting off first with Narayana Health, where the revenue grew about 16% and the profit surged about 59%, pointing towards a strong operational performance by the company. Now moving on to Clean Max, where the company delivered a standout quarter where the revenue has more than doubled and the profit rising 3 times, reflecting strong execution. Now, staying with the earnings front, Glenmark Pharma has also reported an impressive quarter where the revenue was up 23% and the EBITDA grew 33% with the margins expanding, and the profit has also witnessed a multi-fold jump. Another company that impressed was the Blue Dart, where the revenue increased 15% and the EBITDA climbed 34%, while the profit jumped 80%, aided by the margin expansion. Now, shifting focus towards the financial services, wherein CDSL posted a steady quarter with 13% of the revenue growth and 15% higher profit, although the margin softened slightly. Now, on the other hand, Jindal Worldwide reported a mixed quarter for this quarter one, where the revenue growth remained muted at 3%, while the EBITDA declined 25% due to the margin pressure and despite higher reported profit. And finally, talking about Urban Company, wherein the revenue grew stronger at 44%, the company slipped into losses. That said, the management has also highlighted about Insta Health, which has doubled its daily orders in just 5 months, indicating strong demand for the company.
Sameer, some of the platform companies, Urban Company, or for that matter Swiggy, what's your view on that?
Yeah, so I've noticed one thing, that the technicals and the fundamentals are not going in the same order today at all. And unfortunately for me, as much as I think these are great businesses over a longer term perspective, the price that we are paying for some of them today leaves very little on the table for an investor to say that I got a CAGR return of 15+% over a 5-year period. Now, we all know of the fact that the food delivery business is kind of growing at a steady state of 20% for Eternal and about 12 to 15% for Swiggy, because they've kind of stabilized. The profitability on the EBITDA side is decent and they're doing okay. The problem lies for them in the QSR space, right? Not QSR, the quick commerce space. In quick commerce, because of the new entrants coming in with deep pockets, it's not going to be easy for them to grow the volumes as aggressively as they wanted. That's the first part. The second part is when competition comes in, you might be taking some margin hits to ensure you protect your market share, right? So profitability, even though it's there on the EBIT side at this point for both of them, may get pushed back further, and that means profitability does not come. So in the near term. Now, I discussed Eternal with you all last week, if I remember very correctly. 375 crore was the other income, whereas the profit was 95 crores, which means the bulk of the profitability that we are talking of today is coming from its interest income or the investment income that they have for all the cash reserves that they have. It's not coming from the core operations. And when you want to value them on any parameter, I mean, I find price to sales and all these valuation parameters ridiculous, but I mean, most people do it. And I think for me, if I invest today, where are my returns going to come from? They're not going to come. Urban Company is slightly differentiated. It's a platform, yes, but they're kind of a unique play with this, Insta-made business, the kind of services that they offer for people coming. The question remains is, if someone gets used to, now in this business now, for example, I'm just giving, if I'm hiring from Urban Company, say a house help or a masseuse or, a person who comes, my wife orders sometimes for blow dries or whatever. If they get comfortable with that, they start calling the person directly. Urban Company stands to lose out. There's no way of stopping something from this happening. So that poses a bit of a risk. I don't know how the company is going to mitigate something on those lines. Simply put, yes, good businesses, good growth possibility, good everything. But for me as an investor, there are a lot of risks and where money can't be made that easily. So at this point of time, valuations or for other reasons in some of the other companies, I choose to avoid them.
Okay, that's the space, or rather the take coming in on some of the consumer tech names, if one can classify them as that. But a lot of other newsmakers as well that we're going to be focusing in on today. We've talked about Divi's Labs. There's, of course, ITC, and the stock will be reacting to its earnings. But a lot of other newsmakers too. There's Clean Science Tech. They've signed a 5-year supply deal with Kemin Industries. There's Dr. Reddy's. They've got a US FDA approval for a biosimilar for the US market. There's Vari Energies as well. They've received a solar module order. Lupin has got another US FDA okay as well coming in. And then, of course, Divi's, like we said, it's an earnings reaction that you may want to foresee over there. Glenmark as well came out with its numbers, and the top line has grown about over 23 odd percent. EBITDA jump up of 46%. So that is going to be another stock which has had a very sedate or pretty much flattish last month, or rather last 1 month, yes, 1% higher for that stock. So let's see whether these earnings excite that stock any further or not. But Kunal, quick picks from the pharma space. What's looking good on the cards or charts?
Yeah, I think Laurus Lab is something which looks attractive. Divi's Lab, of course, the stock has moved up very much steeply. So a little bit of a skewed in terms of risk reward to enter at the current juncture. Sun Pharma, I think at 2000 or 1970 where the stock closed, I think on Friday, I think it's also a very attractive bet. The stock has confirmed a multi-level breakout. It started off with daily, weekly charts, and now it's moved on to the monthly charts, which should bode very well for Sun Pharma over the medium to long term. Cipla has been a stock which is trying to eke out a breakout above 1500 levels. It's been struggling around this 1470, 1500 zone, but I think there have been almost like 2 attempts to 3 attempts for the stock in the last 1 month. So I would sense that the 1500 level should be taken out hopefully in the month of August for Cipla. That could be another addition to the pharma names. Glenmark, I think, has been a phenomenal mover over the last 4-5 years. 2024 or 23 approximately, the stock was almost at 400, towards a point where the stock, even in the last 5 or 6 consecutive quarters, have shown a positive price performance. So it's been a more like a consistent stock, has done very well in various parts of the market. So pharma overall is looking a lot more better than what it was maybe 6 months back.
Okay. Very interesting. Okay, I'm just going to quickly also touch upon, again, names and numbers. And Samir, I wonder how you look at Divi's numbers. You know, those numbers look extremely strong. That 40% plus kind of margin number just hits it out of the park. I'm trying to understand whether sustainable, how you're looking at those numbers. Good morning.
Good morning, Harsha. So unfortunately, Divi's, like I said earlier also, I haven't seen the numbers, so I don't want to comment on them.
All right. All right. Divi's on charts now at 8,000, I believe, a piece.
Yeah, a little bit of a steep buy at the current levels. I would not suggest a buy for the stock in the last, in fact, in the last 6 days or so, the stock has moved up more than 1,000 odd points. It's been a phenomenal up move for Divi's Lab. 1 day of a huge price up move, then a second day of consolidation. That's been the pattern for Divi's Lab in the previous week. But I think at 8,000 plus, it's a little bit of a steep buy. The risk reward is not favorable. So I'll probably wait for the stock to go into a cool off. And there's bound to be a point where the stock should go into a profit booking.
And some of the logistics names, Samir, coming back to you, Blue Dart's numbers were fairly resilient. You know, the top line growth and the kind of top line absolute number also that has been clocked looks quite good. Would you go out and probably look at or consider some of these names, just given the fact that you've got fuel prices at the pump going higher, but yet you're seeing good traction?
No, absolutely. The numbers for Blue Dart were extremely strong. I think, look, what's happening is with constantly more orders being placed on various online portals, be it Amazon, Flipkart, Nike, name it. I mean, there are lots of them and constant sales happening. The opportunity for all these logistic players who do last mile delivery is continuously increasing, right? The operational efficiencies, the scale, the benefits all come through. So from that perspective, something like a Blue Dart is something that will do well. There is delivery, which is something that will stand to benefit from that. Again, the problem there, competition increasing, more players getting in. In fact, some of these players putting in their own express Bs is now something that is growing, which used to be part of Brain B solution, of course, after etc. But they're talking of that coming for listing. So, with all of that happening, also there's a risk. But Blue Dart and all of these players, I think they're great investments to be made over a 3 to 5 year horizon. We just need to see where the valuation lies, and they're a little bit on the higher side at this point of time. So if you ask me, I mean, this is I'm one of the sectors that I think there's a buffet on right now, where someone should, take an investment where values are decent, and they're out of focus. So one of the sectors that I think is something that people should focus on is something that caters to the railway industry. Stocks like Titagarh Rail Wagons, Texmaco Rail, IRCTC. Nobody's talking about these stocks. Prices have corrected from by 60% from the tops for all of these counters. And I think the next 3 to 5 years, you're going to see continuous growth happening for these spaces. So as that happens, and when the uptick starts happening in profitability, and people start coming back in, the market starts focusing on it, the news channels start discussing it, you might be a little late, or you might have bought it, might have be forced to buy it at a higher price, right? So sometimes it makes sense to focus on sectors that are out of the focus of the entire market, where you can get value and you can get an opportunity to make great returns over a period of time. Unfortunately, today everyone continually keeps discussing stocks which are doing well, which is Eternal, Swiggy. People keep talking about the pharma space, but pharma's run up a lot. Where's the value comfort that comes in it? We are playing purely on growth. 1 quarter of something going wrong in growth, and these stocks can get hammered down. So my suggestion at this point is try to focus on things that are not in core focus. And another space where there's an absolute buffet is the entire renewable energy space. All the stocks are down. Vari, you just discussed one and order. Uh, the stock is down from 3,600, I think, to 2,700 or something around those levels, right? Suzlon has fallen from $60 to almost, I think, $45. Sterling and Wilson is down. KPI Green is down. Name it in the renewable energy space. I think you're getting an opportunity, and the growth is going to be great. These guys are going to make money over the next 3 to 5 years. You're getting them at decent prices. Vari is available at 17 times trailing earnings, with growth ahead of it. So these are investments one should make. They're not in focus right now, but when they do come into focus and they start moving up, you'll actually have your returns in place.
And Samir, just sorry, a quick follow-up. We don't want to be one of those channels that don't discuss some of these trends, but talk to us about IRCTC in particular, because it's been a very long consolidation for shareholders holding IRCTC. What's the thesis here? 25 times earnings, I believe, 1 year forward.
Yeah, so the thesis is very simple. Look, they control the 98% of all tickets sold, right? And as that keeps increasing, the number of trains that keep increasing, that revenue, but that is going to be a very slow revenue growth. The real kicker can come if they increase some of their percentages of revenue that they charge per ticket. A small increase in that of 2 to 3% will lead to massive jumps in profitability, because there's no additional cost to that, right? So the operating leverage is very strong. Second, the water business that they're doing, that is getting more and more steam. So that will start giving higher profitability. But the real kicker, I think, if for me, it lies in something like an IRCTC, is the travel vertical that they're doing, right? The food is, of course, food and rail is doing, water is doing okay. But the travel vertical, the pilgrimages, the various holiday packages that they're putting up, as they're gaining more and more traction, I think what you will see is the operating leveraging playing out. And then suddenly the 25 times earnings will not look like 25, right? They'll start looking a lot more attractive. Look at the ROEs and ROCE of this company, right? Fantastic. The profitability for ROCEs, it's well over the 40% levels, which is excellent. Dividend paying, cash rich. So the thesis is that there's limited downside, and small changes to pricing, small changes to growth, and suddenly they will re-rate. And you're right, it's been in a consolidation period for a very long time. I think if I look at the price, which was probably in 2021, we are more or less getting that price. So it's available at like something that's 5 or 6 years old, the pricing. And that tells me that when the turnaround happens, this will start to benefit, and it's a low risk, high return company.
Right, very interesting. That's the take on IRCTC. But Samir, within the entire railway gamut, is this your top pick? I guess not.
No.
What would you recommend then within
my top
railways?
pick, actually.
Sorry, I missed that.
My top pick.
Titagarh, okay, understood. Titagarh seems like Samir's top pick from within railways. And within renewables, which one would it be?
So I like Suzlon. I say spread it out between three: Suzlon, Sterling and Wilson Solar, and Vari Energies. All three. Vari is more of a fully integrated player when it comes to from the solar cells all the way to the solar panels to the setup of the process. Of the solar parks, because they have a subsidiary called Solar Vari Technologies, which does all the setup of all the solar parks. And then they also have gotten into making inverters and the transmission systems. So that is a very vertically integrated play. Sterling and Wilson is a pure play EPC player. And the reason I like it is because Reliance is going to be setting up this huge gigafactories and Sterling and Wilson being a subsidiary will be getting some chunk of the order, and that is just going to drive their profitability. And Suzlon, because the wind energy space is something that is doing really well, they've come up with new towers of 5 megawatts, which are for the export market, which is going to do well. And of course, in the domestic market, they've come up with a 3 megawatts, which can work in lower wind spaces where there's lower wind. They can put them there. And so they're opening up India as a market, more places where you can set this up, and their operating leverages as they scale businesses will play out. They've done the highest sales in Q1 of any quarter, I mean, any year. And still people after such a, yes, the EBITDA came in a little subdued, but look at the sales that are happening. And once the margins play out, you get a benefit, but the market still chose to sell it off because they're focusing on the 1 quarter EBITDA rather than looking for the next 2-year opportunities.
Interesting. Okay, Samir, thanks as always for your time. Great to be speaking with you and getting these niche ideas which no one in the market is talking about as of now.
Thank you.